Hello, everyone. Thank you for joining us today. I'm delighted to have Haydn Marshall from Lend Perspective joining us today to talk about mortgages and the lending process. I'd like to make a distinction that Haydn's business is Lend Perspective. My business is Perspective Financial Services. Similar names, but we're actually two separate businesses, but have established a wonderful referral relationship so that I can have someone who is an expert in all things relating to mortgages, work with my clients so that I can focus on what I do really well and let someone else be the specialist in their field. So, Haydn, welcome.
Thanks very much for having me, Esther. It's good to be here.
Yes, thank you. Thank you. And nice to see you in person as well, because sometimes with the nature of how things are done today, there's a lot of electronic communications and we don't always get a chance to see each other. So it's always wonderful to have this direct, well, somewhat direct engagement, at least get to see your happy face again. So lovely to see you.
Yeah, likewise.
Thank you. So, Haydn, we haven't got a lot of time to put in a lot of information, but there's lots of information out there that people who are wanting to get a mortgage, whether it's the first time, whether they haven't reviewed their mortgages for a long time, or want to structure their mortgages in a way that has some advantages from an investment tax perspective. I want to hand over to you to tell me what you're seeing with the work that you're doing and where you think people come to mortgages with a little bit of doubt or misconception of how things work, and what your role is in helping make the whole process easier and get a great outcome at the end for people. What would you like to share with us this morning, Haydn?
Okay. So I think there's definitely a broad sort of variety of things that we can look at. But I think if we take it in context of where we are today in the Australian environment and seeing what's happening out there, then we can look at more specifically the role of your existing lending and potentially if you are looking at future or additional lending going
Right. Okay.
So particularly when I look at today, what we're seeing in recent months, we're seeing the Reserve Bank has increased the cash rate, which is now starting to put a little bit more pressure on people who have existing loans. And that's something that may continue into the future. We're not too certain with what's going on in the world, but it's definitely something that's worthwhile keeping an eye on in terms of where your interest rate is currently, and where it may go and how much stress that can impact that can have on your day-to-day budgeting.
Right.
When we look at that style of change in the market, both for existing mortgage holders and people looking to enter the market, it's kind of two big things that we want to consider. For your existing mortgage holder, the way I think about it in terms of financial planning, in terms of tax, you typically want to have a meeting with your financial planner at least once a year. You do your tax once a year. I think at least once a year you should be reviewing your rate.
Right.
And that can be as simple as speaking to a broker or your existing bank, just to make sure that the rate that you're receiving is as competitive as it can be.
Yeah.
Because there are a lot of times where, particularly in the last few years, we've seen people starting to roll off those low fixed rates during the years of COVID. And we're seeing rates that were in the twos and threes go up into sort of sixes and sevens. So definitely it's worthwhile thinking about if you're going to be doing your taxes, if you're going to be doing your financial planning and conversations around sort of broader financial futures, you should also be looking at your biggest commitment, which is going to be your existing mortgage.
Right.
So
That makes a lot of sense, Haydn. And I think when someone goes through a mortgage process, especially if they're doing it for the first time, it can be overwhelming. And part of what you do is make it as seamless as possible. But then there's a misconception that it's a bit of a set and forget. And even if you're not changing your mortgage, and even if the mortgage structure is the right one for you, just to check in, like as you said, you do a financial check, maybe a medical check, a health check on a number of different things, just to see, are you on track with where you are, at least getting the best rate there as a minimum. Obviously, that's not the be all and end all of loans, but every little bit makes a difference.
Definitely. And when we think about the rate, it definitely is something that's important.
Hmm.
But what also goes hand in hand with that is how we structure the loan.
Right.
And that's really probably the key difference between looking at it from a bank's point of view
Hmm.
versus a broker's point of view. Because
Right.
we want to make sure whether you're starting into the market or you've been in your existing home for 10, 15 years,
Hmm.
your needs change over time. And as
Yep.
such, the mortgage can change to accommodate that.
Right.
And,
Yeah.
and really key in that sort of space is if you are entering the market or planning for any change into the next few years, is we look to make sure that the structure of your lending reflects your overall goals and ambitions in the long term. And
Yes.
that's really key.
No, that it really is, and I completely agree with you. Only yesterday I was talking to someone about their mortgage. They have two mortgage splits and a significant offset account, which I imagine, we'll talk a little bit more about. And the offset account was not linked to the right mortgage account, so they're not even getting the benefit that they thought they had by the way the structure is sitting with them at the moment.
Definitely. And when we talk about offset, offset is really important to understand in the Australian context because we
Mhm.
want to make sure that if you're looking at making any changes in the future or maintaining some liquidity in your position to cover any changes that may come over the course of your lending and your financial future, using offset as opposed to redraw on your loan
Yeah.
can have quite significant and different impacts.
Yes.
Just
Hmm.
as a broad stroke as to what that means, redraw is when you put your money straight into the loan account itself, whereas an offset is linked through the back end of the bank system to what is effectively a transactional account.
Yes.
And the reason that's key is if you move money in and out of your transactional account that's linked as an offset, it doesn't have any impact on the purpose of the loan. And that makes for a big impact in the future. And a good example is, let's say you buy your first property, and you may move out of that in 5 to 10 years and turn that into an investment property. If you're using offset, the loan that you've got in 5 to 10 years is still for the property that you purchased originally.
Right.
If you pay that loan down and put the money straight into the loan and then redraw those funds, then think about redraw when you take the money back out of the loan for another purpose. That's
Hmm.
actually effectively in the eyes of the tax department could be seen as reborrowing. So we
Right.
could change the purpose of that
Yeah.
loan, and that has dramatic impacts around your
Absolutely.
tax position.
Yeah. Accountants do not like that. They like a very clear distinction, make their lives a lot easier. And yes, definitely. I mean, when I'm trying to not do your job, but at least explain a difference, I like, I guess this is the financial planning part of it, and where it ties in really nicely together is I try to explain to people that any money that you put in redraw, consider it as if it's a repayment of that loan and you are paying off your loan quicker, and preferably leave it untouchable. Whereas in your offset, you've got available money that you may need at some point in the future. It's there helping your loan and helping you to reduce the cost of your loan while it's there. But if you access it, that's okay. No guilt. We know it's going to be accessed at some point. It's just helping you while it's available. And should you never need it, that's even better. But to really have that distinction from a cash flow perspective, a cash management perspective, as well as, of course, to make it easier for anyone who's overlooking your finances to report it in the right way.
Definitely. And it is all about maintaining that flexibility because
Hmm.
anything can change. I don't know what I'm doing 6 months from now, let alone
Yeah.
30 years from now. So
Right.
keeping that in mind
Yeah.
is very important for your lending.
Hmm. So what are some mistakes that you see people do who either have misconceptions as they approach a loan, or when the loans are in place? Okay, we've discussed the misuse of the redraw facility, but yeah, what problems are you fixing for people?
So I think the key is to think about two approaches. One is going to the bank. The other side is approaching a broker.
Hmm.
At the moment, we're seeing about a little over 3 and 4 people are using brokers today. So
Yes.
I think there's definitely the market has spoken and it makes sense.
Right.
What does a broker do versus a bank? We've typically got about 60 odd lenders that we have access to,
Mm-hmm.
and that means 60 different products, policies, and approaches to assessing your position.
Yeah.
So, whereas a bank obviously has their own products and policy, the big thing that we're seeing is not everyone is assessing in the same way. So, the income that you may have as an employee versus the income that you may have if you're self-employed
Mm-hmm.
can be assessed in very different ways by different lenders, and that'll give you a very different outcome in terms of what your borrowing power looks like.
Right.
So what one bank says is not necessarily and likely is nowhere near what another bank may be able to extend in terms of your borrowing power.
Mm-hmm.
And when you're working with a broker, they'll be able to look at your position and say whether or not it's going to be more effective to go to one bank over another, and the reasoning behind that. And that can be due to a difference in a financial year for a self-employed person versus someone who may have received a large bonus one year or not.
Right.
The other side that is key when you're looking at a broker is to think about them as an advocate for you. And my job when I'm working with my clients is to make sure that we look at their full position and see what are their borrowing capacity limitations. So whether that's their income, if
Yeah.
they've got any challenges around any existing commitments. And what I mean there is things like HEX, credit cards, car loans, personal loans, things like that. And then also looking at their savings position to see where are they now, what are they going to be limited by. And once we figure out that limitation, we can then work with the most appropriate lender for them,
Yeah.
as well as looking at taking advantage of some potential grants and schemes that may be available, particularly for first-time buyers. So we
Right.
really prepare that position and look at if we need to reduce a credit card or pay out a personal loan or a car loan, something along those lines. That can have quite a dramatic impact on the overall position, both in terms of borrowing power, but also in terms of your monthly cash flow.
Yeah. I so love that you use the word advocate because, I mean, if you are somebody who's giving someone advice, I mean, ultimately what you're doing is looking out for their best interest, and there is that advocacy that a person needs because people don't know what they don't know. It could be a very confusing, overwhelming landscape, and the smallest thing, like as we know, a credit limit on a credit card could derail a whole banking process. But people are out there today trying to chase credit cards for points, and they don't realize the implication that one has over the other. And I'm just using that as an example, but your approach with an advocacy mindset means you're taking people through a process and leading them to the outcome, wherever it is that's going to be the best outcome for them, not just be committed to a very small range of products that you might have, let's say, with the bank, and then try to channel people through that. We can't change people's lives to fit a limited range of solutions, but there should be solutions out there that can match the individual's need. And I love that you acknowledge how important cash flow is and all that side of it. I know when we've worked together, it's about collaborating around the strategy and what we're trying to achieve for these people, so that they can have a really good outcome, which is obviously what we want for all our clients, keep everybody happy.
And a lot of that does come down to looking at things more than just how do we settle this transaction. It may be planning for the overseas trip, the wedding, the private school fees, all of these different things that can change. That is very important to think about the next 5 years, not just the next 4 to 6 weeks when you're looking at settling or restructuring a loan, because that will drive how much financial stress you have, how much confidence you have in the next few years. and maintain as many options into the future. Because the other, probably the most important thing I think that differentiates brokers from banks is that brokers are legally obliged to work in your best interests.
Yeah.
So where banks and bank staff are only obligated to work in the interests of their shareholders.
Right, right. Okay. So, so then someone comes along to you, they've told you what they're trying to achieve, you've identified, or you start the process of identifying what is potentially the right solution for them. What do they need to be prepared with to make the process faster and more seamless so you can get the outcome quicker for them?
So I think the key here is whether or not you're a new client or an existing client.
Mm-hmm.
So if you already hold a mortgage, then I think it's relatively quick and easy. What we want to do is confirm your existing loan structure, your lender, and the details of the property that you have securing that loan. We can do a quick check with you to make sure, is your rate effective? Is it competitive in the market? And off the back of that, is there anything else that you'd like to discuss around structure or strategy? So think about the property, think about your most recent loan statements, and then we can compare the market quite quickly for you.
Right.
In terms of if you're looking to apply for a new mortgage, or you're looking to refinance, knowing that you may be able to get a better outcome elsewhere, we're going to be looking at 3 or 4 main areas to prepare for. So identification. So we're going to need things like your passport, Medicare, and driver's license. We're going to look at your existing statements. So your everyday bank accounts, credit cards, and if you've got any existing loans.
Yep.
We're going to look at your income. So typically your 2 most recent pay slips if you're an employee, or your 2 most recent years of tax returns if you're self-employed.
Mm-hmm.
If you've got any other commissions, bonuses, or otherwise, we may need to get a little bit more information there.
Yes.
But once we have that, the bank statements, your ID, and your income documentation, it gives us the majority of the detail for us to assess your overall borrowing power.
Mm-hmm.
We also want to confirm your living and working history. So that's done through an online portal. And that just provides a little bit of detail around your position outside of any documentation. So things like the car that you have, if you've got superannuation, the balances, and things along those lines. So we look at it as preparing that overall position to then give you an assessment and a recommendation. The documentation can be significant on an upfront basis, but once we know your existing details, then a lot of the time it's more just making sure that the statements and your pay slips, for example, are within around 1 month old.
Yeah.
So preparing those documents up front gives us the fastest ability to assess.
Mm-hmm.
Once we get that documentation, we can typically have an assessment back to you within 24 to 48 hours. And then we'll talk about a structure as to what's going to be the most effective loan for you and any questions you may have at that time.
I'm always a little, I don't want to say caught off guard, but it's not a matter of being caught off guard. It's just that when a client pops up with something on a Monday and says, look, I saw something on the weekend, I put in a bid for it, I need to let them know in the next couple of days. Like, that's I generally don't like to work on that basis. It's a little bit stressful. We don't know what we can deliver to people. And I'm very much a believer of, if you're going to be out there in the market, do a pre-approval and so know with some level of certainty. It also helps to identify what your limit is, because back to the cash flow side of things, if you have to extend yourself, be fully aware of the implications, including leaving a buffer for any movements in interest rates, because I have seen where banks and lenders will offer a loan to someone, but the reality of the situation with their other expenditure and what's about to come, like the banks don't ask you, what is coming up in the next 6 months could actually derail their ability to maintain a loan. And that's why I like, really working with you on that side of things, because then I can tell you, look, no matter what you do for these people, this is all they can afford. Even if the bank will give them a loan that has double the commitment, this is what they can afford. But let's just go back to, I mentioned pre-approvals. Anything that would be particularly useful to know when somebody's a little bit more organized, not leaving things to the last minute, and starts the process of a pre-approval.
So not all pre-approvals are the same. It's probably the key here.
Yeah.
It's very easy to go online and find a calculator on a bank website and type in your income, and it'll spit out a number saying you could borrow this. The computer saying that means that no human has actually looked at it and assessed your position. So I would say it's good as an indication. It's not good to rely on that when you are going in to make a formal offer on a property.
Right.
So definitely having a look at speaking with someone like myself, we run your assessment and give you a recommendation. That's a better level of assessment in our opinion. The best level of assessment is when we then formally submit that to a bank, and a human on the bank side actually goes through and cross-checks what we've provided as a recommendation and the documentation. And that will be given to you back as a fully assessed pre-approval. Right. So you know at a high level what's the maximum amount that I could borrow and what's the maximum purchase price I could go to, as an example. Right. We'd like to get that set up, and let's say, for example, you're looking to buy a $600,000 property, and you might have $300,000 in cash. Rather than setting a pre-approval up for, say, $300,000 in borrowings, we might look at getting a pre-approval for higher than that to make sure that if you did find a property that was $650,000, $700,000, or you're at an auction and you were driven to put an extra little bit down to secure that property, you have the confidence of knowing that you can go to that level. Because the pre-approval is a high watermark. We want to make sure that you've got the confidence to go to that level if you needed to. Right. If you buy lower than that, then the conversation is, well, how much money do you want to put into it? How much lending do you want to have as a result? Because it's always good to get that high watermark approved by the bank, so you can reduce it rather than getting it approved at 300 and then needing to borrow 4. So I'd say just one last thing on that pre-approval piece. Once that is assessed by the bank, that's set up for a period of 3 months. So typically, if you don't buy in that 3-month period, we'd be looking for updated bank statements and income documents.
I thought it was 6 months. So they've
some of them will be a little bit longer, but typically you want to be looking at 3 months or 90 days. Right. It is relatively easy with a lot of banks to extend that approval. Yep. But it's key as well in a market that may have a rising interest rate. Yeah. And a good thing to remember, every 0.25% that the interest rate goes up, your borrowing power drops by about 2%. Wow. But hopefully the property prices also drop by that.
So Haydn, what I'm also experiencing, and why we felt it was really important to speak to you, as we bridge some generations, we have clients whose children are wanting to get into the market. The parents want to help the children. They want to do it in a responsible way, and they need to know how it's going to impact their future, the parents' future needs, particularly if they're not working, and then, of course, the children's commitments. And that's where I find the pre-approval really powerful, because the families are generally having the high-level conversations of, we want to help, but getting that concrete information provides some certainty around what level of commitment the children will be exposed to, and how the parents can help, because maybe the parents can't help by giving a larger deposit than they may have intended to, but they may be able to help with extra repayments or something. And so the only way that we can really plan for both ends of our clients is to have that information, and then we can sit down and say, right, this is where we're at. This is what you can do. This is what you can do. How do we bridge it? Then you know what you can go out and do.
Exactly. And I think the key in that is having that conversation up front and seeking that professional advice,
Yeah.
making sure that any decision that's come up with
Mhm.
is appropriate for all parties involved. We want to make sure that if there's any gifting of funds or assistance in one way or the other, we've seen issues in the past where can be tax issues around
Mm.
funds, as well
Yeah.
as if there's multiple children.
Mm.
If one kid gets one thing, then normally the other kids want it as well. So you
Yeah.
want to make sure that you're having that conversation up
Right.
front.
And
And
that's
really,
you know what, that's also critical. Well, I was going to ask you about AI,
Mhm.
and I don't think we need to ask you that question directly. I think we can already jump to the answer of the impact of AI is that having these conversations takes into account so many different elements, whether it's cash flow, the intergenerational assistance, the estate planning, the equalization of assistance between children, etc. There's so many other elements to it and so many details. I cannot see how AI can bring the same level of wisdom to these solutions as sitting down and having conversations with people who've seen it all. And if you've been in business for a while, you've seen it all.
Yeah.
Yeah.
And I think the key difference, I think, with AI at the moment, particularly at the moment, is what AI doesn't know is experience. We know
Sure.
what we know because we've gone through these things over an extended period of time.
Yes.
I'm sure every piece of AI can read a payslip
Mhm.
and calculate things like that.
Yep.
However, when you're looking to make sure that you're planning not just what's the best rate, but what's the most effective structure, and
Yes.
if I'm moving one piece versus another, we want to be able to have a conversation with someone who understands your needs and your
Yep.
position.
Absolutely, absolutely. So Hayden, as we like wrap up this chat, is there anything else that you think is, one or two bits of additional information that you'd like to leave behind to make sure, everybody starts out or considers everything from the right perspectives?
So I think the number one is if you're not speaking to a broker, you should be.
Mhm.
Seek advice and seek that before you go onto domain and look for property. You want to make sure
Right.
you don't put the cart before the horse.
Okay. Yep.
And getting that assessment. Not all assessments are the same, and not all banks are the same as well. So
Mhm.
your outcome at one lender may not be the same as your outcome at another, and that's
Right.
why you need to make sure that you've sought the advice,
Mhm.
have everything lined up so that whatever decision you make, you can make with confidence.
Yep. Okay, that's great. Well, Hayden, thank you so much. Your experience and insights are so relevant. And I mean, I think that's what makes us a great team, knowing that, we can approach things slightly from different angles, meet in the middle, but always, always about how to make sure that we're putting clients in solutions that meet their needs today with consideration to what could be coming up in the future. It's really wonderful. Thank you. I really appreciate it, Hayden. And obviously, we'll keep talking to each other.
Mhm.
Mhm.
Sounds good. And I
Yeah.
appreciate the time that you've given us today. So,
Oh, my pleasure. And certainly, if there's anyone who wants to have their mortgages reviewed or get a health check, a second opinion, very happy to pass on Hayden's details. Another thing, Hayden, I don't know if I've ever told you this directly, but one of the things that I also appreciate about how you work is that there have been times that you've done a health check and the outcome is stay where you are and I can't really help you. And come back perhaps when your circumstances change. And I love that honest approach, because you do the right thing by someone, you don't create extra work for them unnecessarily. It all does come back at different times, and we just want to make sure that people are well looked after.
and getting in probably the other piece on that for a health check or a pre-approval, anything along those lines, there's no cost associated in doing that.
Mhm.
So the best outcome is that everything's working well and you're in a good position. And we just want to make sure that if we can give you a benefit, that we would.
Yep.
But even if we can't, there's no cost in engaging or getting that check done.
Right. Wonderful. Thank you, Hayden. Thank you so much. We really appreciate this chat, and obviously we'll be in touch. Have a
Thank you
great
very much.
day.
Cheers. You too.
Thanks, Hayden.
Thank you.